Hell is coming. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, 3 major economies are crashing as the global downturn deepens. And while many people think the U.S. economy is immune, based on the data we got today, it shows why the U.S. economy is soon to follow the others down. And plus, we have a sponsor for today's show who's unlocking the benefits of virtual and augmented reality, and they just had an analyst initiate coverage on their stock who said based on their research, the price of that stock could almost triple in value. We're going to show you just how we think you can trade it for an easy 30% return. Stay tuned to the end of the show or check out the description or pinned comment for more information. Now, if you're wondering what we're doing in front of the European Central Bank, well, all of a sudden, they've got a lot of questions that need answering. Let's head over to CNBC for today's story with a headline: economic data in Europe just went from bad to worse, in a headline that only someone like me could probably write. And that's absolutely the truth of what's going on in Europe here. Many people believe that the global economy, when they looked at the data, they said, you know what, based on historical trends, it's probably bottomed out because it can't get much worse. There was so much pessimism going on in the European manufacturing sector that nobody really thought that there's any way it could go bad. Well, now it has. The recent economic data is leading to the discussion around what European Central Bank might do when it meets next month. After its July meeting, ECB President Christine Lagarde said the central bank could either raise rates or pause rates hikes. Ultimately, the decision, as with every new central banker, will depend on the data, and the data just got outright ugly. Check this out, because we're going to go through what's going on in Europe, and wait till we get to the U.S. data. You're going to see why we're not too far behind. Here we have the flash Eurozone Purchasing Managers Index, and I want you to look at these numbers. Now, these are just preliminary numbers for this month based on what we know right now. And look at the services sector at 48.3. Now, remember, anything under 50 is a contraction. The lower the number, the bigger the contraction. So now we're seeing the services sector start to contract here at a time, you may recall, and this is very important, that everybody believed that the services sector around the world was going to pull the manufacturing sector up. Wait till you see the details here, because it doesn't look like that at all, because we made the case where manufacturing go, services follows, and it is. And check out the manufacturing PMI at 43.7. Now, anything under 45 at this point is considered recessionary. This is a bad news, showing that things in the Eurozone are indeed getting worse. And look at this. Eurozone business activity contracted at an accelerating pace in August, so it's getting worse as the region's downturn spread further from manufacturing to services, just as we predicted it would actually happen here. And August saw a headline rate of input costs and selling price inflation tick a little higher, but notably, both sectors reported falling output and new orders, albeit with the goods producing sector registering by far the sharpest rate of decline, again suggesting manufacturing is getting worse. The near stalling of hiring reflected an increasingly sharp decline in companies' backlogs of work, which points to the development of excess capacity relative to demand. The drop in backlogs, get this, was the largest since November 2012 if the initial COVID-19 lockdown months are excluded. And while manufacturing backlogs fell sharply again, dropping for a 15th consecutive month, service sector backlogs fell for the second month running. Now, what does all that mean? Now, why does backlogs matter? Because when you don't have enough new orders coming in and you've got your employees, then what do? You turn to your backlogs. Those are those non-priority orders that, that are there that says, hey, when you're ready to do it, get it done. Or maybe the orders came in quite early, so you have plenty of time. And now you start to move through the backlogs. Well, guess what happens when the backlogs are all done and you don't have a whole lot of new orders? Well, who do you not need a whole lot more of? If you said employees, you got it right. Commenting on the data, the services sector of the Eurozone is unfortunately showing signs of turning down to match the poor performance of manufacturing, just as we said it would happen. The services companies reported shrinking activity for the first time since the end of last year, while output in the manufacturing sector dropped again. Now let's move into France to get a little deeper picture here. Look at the French services PMI. It too continued to contract. It was July contracted at 47. Now it's down to 46.7, showing further contraction. Not quite in recessionary territory, but still the contraction is there. How about the manufacturing PMI? Still contracting, although a little bit better at 46.4 from last month's pretty much recessionary print at 45, still validating the slowdown. There was a further slump in demand for French goods and services, while accelerated drops recorded at both manufacturers and services providers. Subsequently, and here we go, backlogs of work fell at the sharpest rate in close to 3 years, but overall employment levels across France, however, rose. Now, why are we seeing that? Because a lot of these companies don't want to lay off people yet. They've trained them, they've got them there, they're holding on to them. And this will impact their margins later on and their profits, but for the moment, there's still this belief that the global economy can turn around. And of course, this is a big question for the ECB and all the central bankers. You've hiked rates, you've inverted the money curves, you've caused this deflationary money cycle, the banks don't want to lend, and now you think the economy is going to turn around? Well, take a look at your data. It's getting worse and quick. Lower volumes of incoming new business led firms to turn greater focus toward backlogs of work during August. Orders pending completion fell for the second time in the past 3 months and to the greatest extent since November 2020. Nevertheless, firms continue to hire. The only question is, how long before they fire? The global weakness in demand is making itself felt in France. The HCOB PMI for new orders from abroad remains well below the expansion threshold of 50, but also new orders overall continue to deteriorate or get worse, which is why companies turn to backlogs to sustain activity wherever possible. Again, leading the question is, what happens when those backlogs are all done? But now let's head over to Germany. Remember, we were just there not too long ago, just the other day. Well, things in Germany look like they're also going from bad to a whole lot worse. And here we can see the services PMI at 47.3 moving down from an expansion the prior month at 52, now contracting. But get this, the German manufacturing PMI, this is what you call a depression level number. 45 and below, you're talking recession. Now we're on 39. We're under 40. Now we're talking depression. It's amazing. There are even things going on there without mass layoffs, but they're continuing to hold on. As been the case each month since May, the latest survey data showed a reduction in total inflows of new business. Again, a recurring theme here. The decline continued to be led by, get this, plummeting manufacturing new orders, with a combination of customer destocking and investment reticence driving the sharpest decline in demand for goods since May of 2020. So we continue to get this repeat sign here that new orders are crashing, they're working through their backlogs, and once those are over, well, the party's ending. August saw a further broad-based reduction in backlogs of work, reflecting a lack of incoming new orders to replace completed projects. Furthermore, the rate of depletion of total outstanding business quickened for the 5th month in a row to the fastest in more than 3 years. But yet total employment was broadly unchanged, at least for now. And how about this? Any hope that the service sector might rescue the German economy? Well, that's evaporated. Instead, the service sector is about to join the recession in manufacturing, which looks to have started in the second quarter. And again, this is exactly kind of what we said, that usually the services sector lags the manufacturing by around 2 months. Now, can it be a little longer, a little shorter? Sure. But on average, about 2 months. And what are we starting to see? That sure enough, the manufacturing base in all of these countries, it matters a great deal because those jobs are much higher paying. Those companies spend lots of money out into the local economies, and now all of a sudden, as that dries up, well, the services sector goes with it. And it's not just, of course, the Eurozone here. We head north now to the UK, and things aren't pretty there either. As the UK private sector output falls, get this, fastest rate since January 2021. The services sector there, after being in a small expansion last month at 51.5, now contraction at 48.7. How about the manufacturing PMI? Last month was in solid recession territory at 45.3, now moving lower, validating the UK manufacturing sector is indeed in a recession at 42.5. Of course, we know where manufacturing goes, the services sector is following. as lower levels of activity were recorded in both the manufacturing and service sectors during August. The downturn in the service sector output was only marginal, but nonetheless the joint fastest for 31 months. Manufacturers, meanwhile, experienced a sharp and accelerated fall in production volumes, which extend the current period of decline to a whopping 6 months. And shrinking order books allowed for steep reduction in the backlog of work for August. This was the fourth successive monthly decline in unfinished work, and the latest fall was the fastest since June of 2020. Excess capacity contributed to another round of job shedding across the manufacturing sector, where service providers signaled a marginal upturn in workforce numbers. But overall, private sector employment continued to rise only slightly. But you'll notice this continuing trend here, the fastest rate since whatever month. Things are moving down. They're moving down quickly, just as this was kind of predicted. You start to look at these inverted yield curves. You start to talk about how the banks curtail lending. And believe me, lending is crashing in Europe. And when you have a lack of new money, guess what? People don't have the demand. They can't go buy things. And inflation starts to come down in a big way. And you start to see the data just as we're seeing now. And yet what's amazing is still people believe that we're facing a second half rebound, a potential soft landing in the global economy, when manufacturing sectors are about to be deep in a depression all around the world. And now let's see why the U.S. is headed next. As U.S. private sector at near stagnation amid renewed fall in demand, here we see the U.S. services sector. Remember, this was supposed to be the revival of the U.S. economy. It was 52.3 last month. The trend was slowing, and now it's at 51, the 6-month low. It's decelerating. It's almost about to contract. And how about the U.S. manufacturing PMI? Look, at last month it was at 49. So you notice it's lagging the rest of the world by a few months. Now it's at 47, just above recessionary territory. And again, this is dangerous news because we are indeed following, and just as we should, as the world's largest importer, we usually see these things last. And following broadly unchanged levels of production in July, goods producers returned to contraction territory in August. The latest drop in output was the second in the last 3 months, albeit only modest. Although still registering an expansion, services firms meanwhile reported the slowest increase in activity in the last 6 months. And softer demand conditions were evidenced by the first decrease in new orders at U.S. firms since February, as manufacturers face greater challenges driving demand as new orders fell at a quicker pace. And this shouldn't be a surprise, because what did the consumer credit data just tell us from the base of the last report? Do you remember the credit card data? It said it contracted. It meant consumers started paying down their debt, so they're cutting their spending. We should totally see this in the manufacturing sector and in terms of new orders, and we certainly are. And while service providers saw the fastest drop in new business since the start of the year, sustained pressure from inflation and high interest rates were often linked to the decline, with some firms also highlighting a greater need to invest in advertising. Well, what they need is the banks to lend. And here we can see, when we look at some of the U.S. data here, we're going to go to the Philly Fed, and this is the current new orders data, because we like to look at some charts, and I want you to see that what the next phase here is for unemployment claims to go higher. And I know many people don't believe that that's going to happen, and it may not happen for a couple months, but will happen at some point, because again, as new orders go down, the backlogs get worked through. Once the backlogs are done, if new orders don't return, well, you don't need a lot of employees, as you can see here. So when new orders go down, this shows in blue, this is a Philly Fed diffusion index, and what you see is a 4-week moving average. Initial claims heads higher. We can see this trend repeated over and over again here, going into the dot-com or in the 90s recession, here in the dot-com bubble, again in the global financial crisis, and starting now, here's this revival in new orders, at least at the Philly Fed data, but based on S&P Global's new information, this is turning and rolling over, suggesting again, it's only a matter of time before layoffs eventually begin. And what does this mean for inflation? Well, of course, central bankers believe inflation is about to rear its ugly head and come shooting up again. But again, when you see demand go down, when you see new orders fall, backlogs get worked through, it's telling you there's no demand in the economy. And that's why you'll notice, kind of since the 1980s and maybe a little right into the 1980s, you'll see that as new order demand goes down, inflation goes down, because new orders are a great proxy of demand itself. If people aren't out there demanding things, you don't get new orders, inflation eventually comes down. You see the two here in the dot-com bubble. You see the global financial crisis, and you start to see it now, again, suggesting that if this trend in new orders rolls over, the inflation story, that rebound story, is over. It's going down in a big way. And what else is going down? Well, that would be interest rates. Here again, something very few people believe, particularly central bankers, who think that rates need to go higher. And yet we keep making the case that eventually they're going back to zero. And that's why when you see new order demand fall, you see rates come down. This is a 10-year treasury yield. And why would rates go down as new orders go down? I want you to think about this for a moment, because if rates go down, what does that usually spur people to do? Spend. And so there's the case you can see here. Let's take a look further. As new orders go down, you see again rates go down. This time the market says rates go up. At some point, that's going to send new orders down a lot, meaning rates are going to have to come down significantly here in order to spur demand in an economy where people just don't have a whole lot of money to spend. But maybe one place they should be looking at is our sponsor for today's show, the Glimpse Group. And here you can find them out on the website at theglimpsegroup.com. We'll have all their information in the pinned comment and the description below. You can find them on the NASDAQ under the symbol VRAR. Again, VRAR. And they're unlocking the benefits of virtual reality and augmented reality. And we're going to show you here in a little bit that analyst report. They just initiated coverage. Their research says this stock is massively undervalued, could buy as much as triple in value. We're going to show you the initial trade setup where we think you can capture a quick 30% return when all of this attention hits this stock. But let's take a little bit deeper look at what's going on with, of course, the Glimpse Group. And Glimpse is a diversified VR and AR platform company. They've been in operation 6 years. They've got 100 customers, 7 subsidiaries, and over 200 developers and 3D artists, running a unique model that's specifically designed to meet the challenges of an emerging industry, diversifying risk and fostering innovation, collaboration, and the development of a robust VR/AR ecosystem. And here you can see on their chart something that also looks robust is the fact that the price is sitting right above support, suggesting that perhaps whoever's behind this analyst report, which will show you maybe someone's been snapping up some shares and would love to see the stock go a whole lot higher. You'll note when it gets down to the supply zone, as of time of recording, was trading around $2.91, is hitting the supply zone right here. That takes it up to the first zone here. Well, you'll notice there are sellers, and you can see momentum's just starting to pick up here. So the first zone here works out the shorts. You get up here to this roughly $4.11 level. You see there's a massive number of shorts here. If this can get worked out, and here's just first 30% move. You get through the $4.11 level, and man, you're watching a breakout because a lot of people are short. They're going to have to cover. And one of the reasons they're going to have to cover this is because strong alignment of interests are propelling the value creation here. And as more analysts get behind the stock, you can only imagine it's going to get a lot of attention, because Glimpse, they own each subsidiary. And on the other side, the subsidiaries own in the part of the parent company, and they have economic interest in their subsidiary. The plan is, and the model is, to create joint synergies and economies of scale to incentivize employees, maximize exit opportunities, and value multiplier effect across the entire ecosystem to become the premier VR/AR software and services company with a global footprint. And here you can see their companies are QReal, Sector 5 Digital, Brightline, Foretell Reality, Spear XR, XR and Immersive Health Group are all part of the Glimpse ecosystem. And one thing here, as we dig deeper into their stock, we can see that trade set up now as the price is looking like it's going to accelerate higher here. It bounced off support as we look at the 90-day chart. This is showing a 2-hour candlestick. It came down, reconfirmed that support, that supply zone. Buyer stepped in there. It's sitting right now again around $2.90 at the time of recording, suggesting the next move as attention gets on this stock, because that report just came out the other day, sends it right up to $4, that $4 level. There's your 30% return on the way to a potential bigger move higher. And here you can see from West Park Capital, Technology Research is initiating coverage with its price target at $8.87. At the time of report, it was $2.96. And they're saying, look, this company is a creator of enabling software, offers significant growth potential in the augmented and virtual reality space. And they're initiating coverage with a buy of 887 price target as the Glimpse Group trades at 2.9x on fiscal year 23 revenue estimates versus a peer group which trades at 9.4 times their fiscal year 23 revenues. We believe that assigning a discounted multiple of 5.4, the midpoint between the peer and the current Glimpse valuation, provides an appropriate level of safety for our investors. Our target price to sales multiple of 5.4 on our fiscal year 24 revenues leads to a price target of 887. And here you can see in the short term now, if we zoom into the 1 hour chart, you can see again tagging support there, tagging support again. You see the buyers are right there, just under $3 a share, currently just about where it's trading today, suggesting that once these buyers are all in here and that takes a stock up, break through this recent zone of sellers here, and now you're talking a potential 30% return to the upside on the way to a much bigger return based on, of course, Westpark's research. And with that, I'm Steve Van Metre. Thanks for watching. And with all of our stocks featured on this company, you're under no obligation to purchase them. Be sure to do your own research before buying or selling any trade, and make sure, as always, you be sure to use a stop loss. And with that, thanks for watching. Thanks for being fans. Bye now.